So Al went out and took a look at Ford. Kind of ironic. I was talking to a friend of mine who used to work for BetterTrades, and she had been talking about Ford as well. So Al takes a look at Ford and says, you know, Ford's now trading above the 200 moving average, similar to what we saw on the S&P. Yep. Stock trading about $15 a share, starting to move above its 200 moving average. So you guys tell me, does this look like something that could potentially move higher now that it's retaken its 200 moving average? Yeah, it seems to. So if it rallies higher from here, on a technical basis, this could be something that you can do buy a call, right? Or do a synthetic long. And so Al went out and put together a paper trade on this, a synthetic long, buying the Ford, looks like January 2017 call option and put option. So let's take a look at Al's setup here and see what it is that he was looking for or looking at. So we'll go out to January 2017. Wow, you're going way out. Now, the stock is trading at $15.24 right now. So if we go out and we buy the call option, it's actually not that expensive, right? I mean, we buy the 15 call if we want to go right at the money for January 2017. It's $1.55. Now, we could go in and right now sell the January 2017 15 put for $1.80, meaning that we would bring in 35 cents of credit for doing this trade right now. Now, and this goes all the way out to January 2017, so I kind of like the structure of this trade. You're selling an out-of-the-money put, and you're still bringing in a credit, which is kind of nice, very nice. A lot of people playing this. Look at these open interest numbers here. And they seem to be skewed to the call side somewhat. So I kind of actually like the setup here. So I don't know about you guys, but I think for 30 cents of credit, it's probably worth taking a look at this. What do you guys think? You guys think? What do you think about just as what is Ford's ATR? I don't know, Jeff, but we got like a freaking year and a half. What does this ATR need to be? In fact, quite honestly, now let's go and check some numbers on the covered calls, but stock over the last month has moved from 13 to 15. And it looks like now we're going to have to watch how we time these, but I can bring in 4 cents on the 1550 call, probably a nickel if we continue to move up a little bit. It's $50 on 10 contracts, $500 of income on 100 contracts. Premium's not huge there. We would have to really watch how we time these, but I think it might be worth, just as I'd rather watch grass grow. If grass is willing to pay me, I will watch it grow. So just looking at the last time we were at where we're at right now, crossing the 200, $10.74. We double topped at 18. It's an $8 move. More importantly, it's about an 80% move in stock price. Yeah, I'll watch that grass grow. So I'm going to buy the January 2017 15 call option for $1.54. And I'm going to pay $1.54 for those. And then I'm going to sell the January 2017 15 put for $1.80. So $1.80. I'm bringing in a natural 25-cent, 26-cent credit there. The beauty on this one is I didn't pay anything for this trade, and I only tied up. So let's go through and draw this trade out for you guys, for those of you especially that are new. Daniel says they've got earnings on the 27th, which is perfect because now we know how to manage that, and we'll draw that out as well. Deed says, why not do the 17 strike and get paid $2.25? In this case, I think it might be. You could. Selling a deep in the money put option. Getting paid $2.25. You've got more cushion there. Price line's moving again. So on forward, from 10 to 8 is an 80% move off of the bounce at the 200 moving average. Here's the answer to your question, Jeff. Why would we do it? We crossed the 200 moving average at about $4, peaked out close to 20, maybe even pulled back here to 10. So 4 to 10 is a $6, 60% rally. Then we came across the 200 moving average again with an 80% rally. So we seem to rally somewhere between 60 and 80% on moves across the 200 moving average. So if we're at 15 now, takes us to about 27. And what's our risk in the trade? right? What's our cost in the trade? Because we'll stop out at our credit. So our risk in the trade is essentially nothing. Our cost of the trade is negative 25 cents, right? They paid us 25 cents natural credit to do the trade. So from a reward to risk ratio or reward to risk basis, if I'm looking at a potential here of an 50, 60, 70% upside with essentially no downside risk because of the, now we've got earnings to contend with, and we'll deal with that in a minute. But looking at it just from reward to risk ratio, do any of you other than Jeff see a value in this? Because Jeff's still busting on me. He's like, the risk in the trade is boredom. It is. It's boring making money this way. I mean, I see it, and let's just go there for a minute, and let's say that we go to from 15 to 25. That's $10, right? We would make $10 on this trade